Ladies and gentlemen, Stephen Welton.
It's a great pleasure to be here today, and I hope we can have an interactive sort of conversation rather than me just talking at you. Just be interested to start off with, if I asked, I'm not asking you to put your hands up here, but if I asked everybody in the room, have you tried to raise money before? I just think, well, I've asked that question. How many people have tried to raise money before, debt or equity? So if you keep your hands up, and how many of you found it easy? And that tells you, so no, one person found it easy. He should be the chap who's up here talking to you. Raising capital is something that every single business needs to do at some stage in their life, and nobody finds it easy. And it isn't easy to raise money, but there are reasons for that. Partly it's the people who provide the money, partly it's the people actually looking for the money, small companies. And what I want to talk to you about today is something that we are all very excited about, my colleagues and I, now that we are sort of into our full stride in terms of setting this company up. And we have a great opportunity to work with lots of SMEs across the UK, and that's a great privilege as well as a very exciting opportunity. And one of the core things that we talk about, there is more to what we're doing than just providing money. Capital is clearly critical, but you need more than capital. You need support. You need people who are going to work with you, and it's very much a question of partnership. And we're very lucky. We're setting up a startup. We have one big advantage over most startups, so you could say this is the mother of all startups because we've got £2.5 billion. So we experience growing pains, but our growing pains are slightly eased by the fact that we actually have a lot of capital. And what that means is that we hopefully are going to be able to do our jobs properly and work with lots of companies. So just to talk to you about how did we come into existence, we are actually the product of a task force, which sounds like a terrible way to create a business. So imagine lots of people sitting around a table. The government, as you know, is keen to get the economy growing. They're very keen that the banks should be doing more, and there was a big discussion with the banks going back over the recent months, and no doubt will continue for some time to come. What can you do to further create and stimulate the economy? And one of the things that is a time-honored problem, and it's been here for a very long period of time, it goes back to the 1930s, small companies are always going to find it harder to raise capital than big companies. If you're a FTSE 100 company, you have lots of different options in terms of capital markets. People always want to lend money to you because you don't need to borrow it. I mean, it's again a very simple sort of premise. Small companies are always going to find it harder, and they're going to find it harder in times of economic difficulties like now. If you go back to the 1930s and the Depression, it was obviously difficult at that period of time. And this is a structural requirement because I'm sure in 80 years' time, there will still be a need for small companies to find good sources of capital. So what the Business Growth Fund is, very simply, is a structural attempt to create a long-term source of capital for British companies right across the UK, and clearly Yorkshire is a critical region within the UK, and we have enough money to be able to do this properly. If we had a £50 million fund, I have no doubt that we would be able to help a few companies. We're not going to help lots of companies, and what we're trying to do is dramatically expand the market in terms of access to capital for businesses. So £2.5 billion means that we get asked lots of questions, and I get lots of suggestions about how I should be doing my job, but I'm not typically asked, have you got any money? And that's a good start when you're in our business. So we have credibility in terms of finance. What we need to do is obviously make sure that we can start to deploy that. And what have we actually been doing? And I'm coming on to that. What's our objective of success? Because if you're running small companies, one of the questions you should be asking yourself is, where are you going with your business? What is going to constitute success? For us, success is very simple. If we're here in 10 years' time, we have succeeded. That means the shareholders haven't taken our funding away. We must have worked with lots of companies across the UK which will be successful. We're not running a charity, we're working with businesses that have potential, and this conference is all about growth. This is all about businesses that have potential and are excited about the future. Those are the companies we want to be able to work with, and if we successfully back companies, we will find that the capital we invest comes back with a return, and we can invest in more companies. So hopefully, in 80 years' time, we won't need another initiative to create something for small companies. A critical element, I believe, in terms of whether you're providing debt or equity, but certainly in investment, it's got to be local. There's no point having a big institution in London with a big pot of money. There are companies in London, and they need help as well, and in the southeast, but we need to be very regional, with people who know and understand their local communities, and fundamentally are actually credible, and people want to work with them. Now, we started from scratch last March when I joined, and we launched the business in May, and I was employee number one. We are nearly now up to 60 people, and we have 6 offices across the UK. So we are growing ourselves very rapidly, and we will continue to grow, and we will hopefully meet a lot of demand, and we'll continue to invest in the regions that we're in to build up more people, and more people who are local. I think the striking feature about the group of people, and this is just some of them, they all have a lot of experience of working with small companies. They've all done a lot of investment over the years, so they have what is a key ingredient. They're able to talk to companies, hopefully in a very straightforward way, with the benefit of lots of experience. If I go on to something that's very much in the press at the moment, and if you read the papers every day, the government is saying the problem with the economy is the banks are not lending. So if we kick the banks hard enough and they start lending more, then the economy will just magically start to get better. Now, clearly there is an issue with access to finance. There is an issue with banking, and it would be naive to assume there wasn't, but it's equally naive to assume it's just all about banking. And one of the things that we very much focus on with companies is not so much how much do you want to borrow, it's how much are you actually raising and what are you using it for. So what are you raising capital for? How are you going to invest in your business? Once you've made that determination, then you should think about what's the optimum way to raise capital. One of the reasons the economy is in difficulties is that people, countries, companies have relied too much on debt. Debt is a wonderful thing if a business is growing. If you go into a downturn, debt has some nasty features to it, like repayments, because you have to repay the capital, you have to repay the interest, they have covenants. And I think for us, the debate needs to be a little bit more sophisticated. What is the right way to fund your business? In much the same way as you manage your own personal finances, what's the right way to plan for the long term? And we understand these issues. The fact that we have banks as shareholders is clearly pretty helpful. It gives us the ability to talk to banks. We're not bankers, we're not lenders, but we do understand that the way that they think. Equally, I like to think that we understand the way entrepreneurs think. I don't think I've ever met an entrepreneur who sort of wanders up and says, you know what I really want to do is give you a piece of my company. No entrepreneur wants to give up a piece of their company, and if it's just a question of, I'm going to take a piece of your company in return for some money, it'll be a very short conversation. The dialogue we have is very much around working in partnership with entrepreneurs and with people growing their businesses, of which a key ingredient is money, but it's not the only ingredient. If I go on then specifically to what is it that we do, we are providing between £2 and £10 million per company of the companies that we invest in. We do not want to provide tens of millions of pounds. We have 2.5 billion, so it's not that we lack the financial capacity, because the great danger in our industry, and one of the things that has happened, is that it's too easy to invest larger sums of money with fewer people. And it would take us less time to invest 2.5 billion if we were investing at 100 million pounds a time. But that isn't going to enable us to work with lots of companies across the UK. So by design, we want to work with lots of companies which are smaller, medium-sized businesses, rather than cherry-picking a few and investing in large sums of money. We are not set up and geared up to support startups, and that may be an interesting point of debate if we get to that stage. Why is it that we don't finance startups? We are an institution, so we have to do things in a certain way. I hope we're not bureaucratic or too formalistic, but we do have processes to go through. In my experience with startups, they're normally reliant on 1 or 2 people. They're moving very quickly. They need quick decisions. They're not geared up to doing due diligence, writing long business plans, having people crawling all over their business. It's totally unrealistic. They need access to quick capital, and they need people who can make quick decisions. And the best way to do that, I strongly believe, is through private investors and through angels. And the government is very keen to try and promote that. And we now have, as I'm sure you're aware, through the Enterprise Investment Scheme and the new Seed Scheme, which starts next month, tax incentives to encourage wealthy people to invest in startup companies. And the tax incentives in the UK now are the best they are in the world. That doesn't mean that it's not easy or it's easy to raise money for a startup. It isn't. And the way we try to think about things is almost like a ladder. The first step on the ladder, which will always be the hardest step, is to set up your business from scratch. And most people will raise that money initially from friends and families, and that could be a few £1,000s. You then need to raise, say, £100,000. Angels are a very good source of that. When you've then got the business to a sort of threshold level of turnover where you need both capital and broader support, that is where the Business Growth Fund comes in. And we are not completely arbitrary about this, but we've said turnover of around £5 million is a good indicator of a company that's likely to be large enough to be able to work with an institutional investor. So they're likely to have a bit more management bandwidth to deal with an outsider, and they're likely to be able to successfully take an investment of millions. And one of the questions we very simply ask to companies that approach us, just imagine your fairy godmother arrived and money was no longer an object. What would you do with your business? And that is a very disarming question, because a lot of small companies are not thinking about their fairy godmother, surprisingly enough. They're thinking about tomorrow's problem and next month's problem, and how do I finance the working capital, and what happens at Christmas. They're not necessarily thinking, where's the business going to be in 5 years' time, being much more strategic, and that's what we want people to think about. Strategic does not mean being unrealistic. It means having a long-term plan, and all of you as entrepreneurs will have set up your business because you had a vision. And you want to always stay true to that vision, whilst recognizing in the short to medium term you have practical problems to get over. Again, in terms of core parts of our message, we do not buy companies. We are not a private equity firm. We don't do buyouts. There's nothing wrong with buyouts. There's nothing wrong with the private equity industry, and I've spent many years in that industry, but it's a different offering. We are minority investors, and we are the junior partner working with the companies we invest in. And that is very, very important, because I think there is a huge amount of cynicism or distrust about anything to do with money. And the government is not necessarily helping by demonizing the whole banking industry, but typically, if you speak to any small company that's raised money, there is an element of suspicion around who's providing that money. What do they really want? And are the terms going to be very onerous? And are they going to steal the company from under my feet? Are they going to force me to sell the company? Am I going to get fired? And these are all real live issues. The way to address those is very directly, to be extremely transparent. And the first point of that is that we do not buy companies. We invest as a junior partner alongside the majority owner, and we will always do that. Another core part of what we're doing is to recognize these companies will benefit from more than just capital, so we do want to sit on the board. That's not as a policeman, again, it's as a partner. Often it's going to be one of the people within the Business Growth Fund. Sometimes it will be an outside director. And we've just done a transaction which we announced last week of a manufacturing business. It's a company that makes pipes and plugs that go into the offshore oil industry. So it's quite sophisticated, but it's very much a manufacturing business serving a global market. We're just about to bring on board as a chairman for that company. This business turns over around about 20 to 25 million. The person who's going to come on board as chairman is one of the most well-known and successful executives in the oil industry. And that's a fantastic coup for this business. And the owner thinks, well, that's brilliant. I can get this person to come and help me. He's not coming to help me to run my business. He's coming to help me to give me the benefit of his perspective. And he gives a different dimension to the board. He opens up contacts that potentially that company wouldn't have been able to access. And that's very, very important. And then you think about time frame. As a country, we are all, and certainly I think if you listen to the debate, we're all guilty of trying to think that we can solve problems tomorrow. We're not going to do that. The Business Growth Fund, we've been going for a few months. We've now made 6 investments. Now, people turn around and say, well, what's the problem? You've got £2.5 billion. Why is it taking you so long to invest the money? Maybe the management's not very good, so maybe we should change the management. We will invest the £2.5 billion, and we will invest it well, and we will work with a lot of companies. But our time frame, I think, is quite rightly measured in years and decades. It shouldn't be measured in months, and businesses should plan that way as well. And what is important in terms of the way we've been set up is that we invest from our balance sheet. So we are, whilst we're called the Business Growth Fund, it isn't actually a fund, it's a PLC, and we have a big balance sheet. And that means we will be able to structure investments to meet the needs of companies, and we can take a long-term horizon. What does that mean? 5 years, 10 years? In a way, it doesn't really matter. I go back to what I said originally. What is most important is why are you raising capital and what are you going to do with it? We then have the flexibility to structure around that. Moving on to the process, and asking that question right at the beginning, is it easy? It's not easy. And how do we try and make the process as efficient as possible? I think there are a few simple principles here. One of them, which I've said, put up on the slide there, if you're not going to be able to help somebody, and there are many situations where we're not going to make an investment, maybe because the person doesn't want to actually raise capital. There needs to be a catalyst. Why are you raising the capital? Maybe we can't agree on terms. Maybe we have a different view on risk. I mean, these are all very valid business reasons. What is not valid is to take a long time to make up your answer. And I'm sure, again, in business, all of you must be involved in sales in some respect, and raising capital and effectively selling capital is no different. If you're not going to be able to support somebody's request, there is nothing worse than a lingering no. If you can't help somebody, tell them why and tell them why not. And many of the companies that we've already spoken to for one reason or another may not be raising capital now, but we're pretty confident they will raise capital in a year or 2 year or 3 years' time. And they're on what we call our shadow portfolio. These are companies that we've got to know. Critically, they're getting to know us, and it goes back to this element of partnership. In terms of how long does a process take, if we met somebody today, to a certain extent it's how long is a piece of string. If you're ready to raise money, if you've actually got a plan that you can put forward and communicate clearly, there is nothing slowing us down to make quick decisions. But on average, we think it takes 2 to 3 months from the first time we meet a company. And that's not because we are hidebound by taking that period of time. It's just a realistic reflection of the fact that you have businesses to run. Your business is not raising capital. You have to do this in your spare time, as it were. And that's realistic. I think it gives us the opportunity to get to know the business as well. And a core part of our investment philosophy is time and access to the company. And what does that actually mean? It means spending time with you, understanding your business. Not with lots of other people telling us about your business, but very much with you. It gives you the opportunity to understand the people who are going to be your partners. So if you think about this in a sort of personal sense, we don't want shotgun marriages. We sort of want long-term relationships. And getting investment ready is really what you need to do. If you are going to raise money, you need to put yourself in the position of the person you're actually going to. Most of you will have a very clear view of what you want to do with your business. Not as many of you will have a very clear view of what a bank or an investor would think about your business. And getting investment ready is trying to understand what is the person on the other side of the table actually thinking. What are the issues that are important to them? And so, like anything in life, the better prepared you are, the more likely you are to be successful. The age-old adage about raising money from a bank is go and ask the bank for money when you don't need it. And that's because they'll lend it to you at that point. But there is a more serious point within that. Get to know people who could potentially help you before you actually need their help. If you wait until you're running out of money, you've got an order and you have to find capital, that's not the ideal way to do things. So just as you are involved in product development, you're developing your brand, you're thinking further ahead, you should think about raising capital in that way. One of the reasons we go back to working with companies that are a little bit bigger, with millions of turnover as opposed to hundreds of thousands, there's normally a finance director alongside the chief executive. This should be something that a good finance director is thinking about, introducing the chief executive at an early stage to somebody like us. We're very happy to meet companies, even if they don't meet our criteria today. We can helpfully be helpful to these businesses, we can point you in certain directions, and we get to know you, which is very, very important. And there are no shortcuts. You must prepare for this process like anything else that you would do within your business. And so what sort of things need to go into your business plan? I've talked about why do you need the money. You have to join the dots together. Very few plans, probably no plan I've ever seen, is anything other than a hockey stick. And really it's really the nature of the hockey stick. Because every business succeeds in the plans that we've looked at. No business ever fails, no business ever goes bust, but in the real world that happens. So be credible. If we ask an owner, are there any risks in your business, what worries you? If the answer comes back, well, there's nothing really. I mean, that can't be true. There's got to be something that worries you within a business. Maybe you're controlling the risks very well, that's fine. But what are the risks and how do you manage them? And how do you translate business performance into financial performance? We had a very interesting discussion this week around a company that we are talking to. And they've got a plan, which is a very, very aggressive plan. This company is growing incredibly rapidly. We're having a very interesting debate with them about the rate in which they are building up their overheads whilst they're building their top line. Not because we don't think they know how to run their business, but the financial profile and the risks they're building into their own plan is almost too great. It's almost chasing sales at every expense. and not worrying about the bottom line. You've got to be able to do both. There is nothing wrong with investing for growth. There's nothing wrong with profits going down, but you've got to have a very sustainable cash flow in the long term. And we will challenge and work with the companies in a very constructive way. We're not trying to be clever. We're not consultants telling you how to run your business. But as investors, we're definitely going to work with you to really interrogate what are the pressure points in your business. Where are the opportunities? And often one of the things that we will identify with you is greater opportunity than you maybe thought possible, because the capital, the access to people, can actually achieve more. One of the things that is worth coming back to, because I believe this is probably a big hidden obstacle in the country to raising money, and this is true with banks and it's true with investors, and it will be true of us unless we sort it out. Diligence is almost like a sort of form of modern-day torture. What does that actually mean? You have this great agreement and then it's subject to due diligence. And due diligence can mean a lot of different things to many people, but for most companies who've been through it, it's not a particularly pleasant experience and it takes too long. Simplifying it, it's too onerous, it's too expensive, it takes too long. And for many businesses, if you hear those stories and those anecdotes from people you work with who run other businesses, one of the consequences is that you'll say, you know, I've got other things to do, I don't want to go through this process, it's too hard. I haven't got time to sort of take myself out of the business for the next 6 months just to raise money. And there is a reason for this. We have almost, in a way, we've become far too complicated. There is risk in every business. There's obviously risk in being an investor, there's risk in lending money. You can't mitigate risk by trying to identify every possible risk. Risk is all about judgment, and judgment is based on working with people. And what we are trying to do is very much approach this industry with a blank sheet of paper. And what does that mean? If it takes too long to raise capital because the process is too long, why is the process the way it is? And why is it that, say, the legal process, legal due diligence, which is a potentially open-ended area of discussion with a company, why do you need to know everything about what a company does? It's far more important to say, well, this particular company's got contract revenue, so I should look at the contracts. I don't need to know what their environmental policy is. So we're trying to make diligence very specific to the company. The net effect of all of this will be, and this is a plan, we haven't got there yet, we should be able, once we agree a heads of terms, so an agreement in principle with a company, to complete that investment in 4 weeks. Nobody can do that in the country at the moment, and we can't do it yet. But we are going to get there because we have the ability to make our processes fit our requirements. There isn't anybody telling us what our diligence should be. That's our job. So our investment committee, which I chair, is completely internal. We will drive our process to meet our requirements, and if we do that, we will speed up the process. If we speed up the process, that does not mean we are cutting corners. It means that we're focusing on what is really important. And I believe the more we can unlock this, the more we will find that there are companies out there who want to talk to us and who want to talk to others.